what are the top things that you look for in operators before investing with them?
I had this conversation with an investor I was talking to yesterday who's just getting started, and he asked me, what's the first thing you should be looking for? And you and I know that it's the horse and the jockey illustration. In a horse race, which is more important, the horse or the jockey? And in multifamily, it's who's more important, the operator or the asset, the market in which they're in. And the answer is always the same. It's the operator or the general partners. Who are they? Who are they? And do you know, like, and trust them? What's their success record or track record? I know very few people that don't have a blemish someplace along the way or a war story to tell. I know very few that come out with it right away and tell investors some of that history. So the first thing for me is the general partnership group. How do I know them? Where are they trained at? Do they come from Lifestyles or Jake and Gino or Mark Kenny or Brad Sumrock, any of the big groups? That's not bad, but I personally want to see that they have some multifamily training.
Mm-hmm.
And each of those groups has a different plus and minus. So it's the group, it's where they came from, because that tells you something about their underwriting style and the templates they use. And so I've had the advantage of seeing many of those different templates and how they work. So I have familiarity with them, comfort with them. And then I start digging into the underwriting assumptions. So what's the reversion cap rate? What's the growth, income, income and expense assumptions for growth? Reversion cap rate, I think one of the most often overlooked ones is understand the relationship between the general partner and the on-site property management company.
Mm-hmm.
Have they worked together before? Is this the first time they're in this market? Does the property management company have experience in the asset type you're looking for? I mean, perhaps they have a Class A focus and you're looking at a Class C property. And again, you need to understand the relationship between the general partners and this particular property management company, because they're the ones that are on site day to day, and they're the ones that are going to make this an average investment or a great investment.
100%. Yeah, they're the boots on the ground, and that's a really good observation too. Do you have what are the pros and cons when you see that it's a vertically integrated property management, meaning the operator, it's their company, versus using third party?
The operator in that vertical integration, right? They have their own property management company. They have their own construction company that are making unit turns and renovations. I really think that is a strategic advantage this day and age. In the last couple of years, as the markets become tighter, I think those companies that are vertically integrated have an advantage because they can control their cost. There's a disadvantage, though, that they're making money on multiple pieces of the business, on the asset, on the property management side, on the construction side, et cetera, et cetera. And so you have to be careful.
Do you ever have concern about transparency risk?
The ones I know of and have invested in, I'm not, because they have disclosed it and they've talked about it in a very transparent manner. And I think you just have to ask the question, if you're an investor, how are you being compensated, Mr. Partner, general partner?
Which, if they're doing a syndication or fund, that they have to disclose that anyway. But doesn't mean that they will, or that it's going to be that clear.
It may be buried right on page 55 in font 2.
Correct.
And that should be a red flag to a potential investor. But I think at least, and I don't think that vertically integration works until you get around 1,000 doors in a specific region. So other ones, if you see people trying to vertically integrate and they're in 3 different states and different submarkets,
at that point, it becomes an operational anchor. Because
they got overhead they got to cover.
Yeah.
And they're sending people from Texas to Louisiana or Ohio or wherever.
And time. Really, because all property management, it's a complicated business anyway, but it is a business, and a new business, a baby business. A new business is like an infant. It requires a lot of attention, or like an infant, its health really deteriorates if you don't take good care of it.
Yeah, but that's a good illustration. I like that.
So yeah, that's a good observation on the property management and that relation to the GP, because you're right. If they do have concentration of units in a market, then it absolutely makes sense. They have to vertically integrate, otherwise they start losing efficiency.
But I really like the third party style. Maybe it's because I haven't gotten to that 1,000 doors in a specific submarket yet, but I think there's strong advantages to third party property management. One of the guys I invest with most has about 10,000 doors, and he does nothing but third party property management. And the argument there is you can leverage them to do things that operationally you don't have to do or want to do, and apply pressure to them to make changes quickly, and they become so dependent upon you anyhow, because in that situation they're huge. We bought, for instance, we bought last year a 60 unit brand Class A building here in Houston, and not many people want to manage a 60 unit, but we got affiliated with a large property management company, and in that case, it's been wonderful, because on that side, it's the only one we have in this market right now. And in that example, it's been wonderful because they bring the leverage and they bring the economies of scale that I could never have as a sole operator of a property management firm in the Houston market. They have every contact imaginable, from, tax consultants to window repairs and everything in between.